during the quarter under review. The overall demand scenario for housing loans remains steady. Further, as informed in the Q1 and Q2 conference calls, the company had undergone through transformational changes during last year, including technological changes, as well as opening up of new marketing offices and introduction of special cluster offices for credit appraisal process. And as a result, we witnessed significant improvement in all areas of operations of the company. In FY23-24, the year has been the best in terms of margin and profitability with record PAT and NIM. Now I would like to share the key financial highlights of the quarter, which are as follows. Total revenue from operations grew from 6,415 crores to 6,936 crores for the corresponding quarter, Q-on-Q, a growth of 8%. Outstanding loan portfolio stood at 2,86,844 crores against 2,75,047 crores as on 31st March 23, reflecting a growth of 4%. The individual home loan portfolio stood at 2,44,205 crores as against 2,28,730 crores as on 31st March of last year, up by 7%. And this individual home loan portfolio comprises 85% of the total portfolio of the company. Total disbursements for the quarter was 18,232 crores as against 16,027 crores in the corresponding quarter last year, a growth of about 14%. Out of these disbursements, in the individual housing loan segment, we disbursed 14,300 crores as against 12,406 crores of Q4 of FY23, up by 15%. Project loans were at 1,501 crores compared with 1,554 crores in Q4 of last year. The last quarter of FY23-24 was the best quarter of the year in terms of disbursements with sequential growth as well as YOY growth. On the interest income front, NII net interest income was 2,237 crores for the quarter as against 1,990.30 crores for the corresponding quarter of FY23, a growth of 12%. Net interest margins for the quarter stood at 3.15% as against 2.93% in the previous quarter. In the previous quarter of FY23. NIM for all the quarters of last year has been consistent and in the range of 3% or above. PBT, profit before tax, for the quarter stood at 1,476.18 crores as against 1,444.78 crores, a marginal growth of 2%. Profit after tax for the quarter stood at 1,090.82 crores as against 1,180.28 crores for the same period previously. And PAT, profit after tax, stood at a record high for the year on year. PAT for FY23-24 stood at 4,765.41 crores as against 2,891.03 crores, showing a significant growth of 65%. Yesterday, the company declared a dividend of 450%, that is 9 rupees per share. In terms of asset quality, the stage 3 EAD exposure at default stood at 3.31% against 4.37% as on 31st March of last year and 4.26% as at the end of the previous quarter, that means 31st December 23, reflecting a sequential as well as a YOY improvement in the same. Total provisions as on 31/3/24 stood at 6,270 crores, with stage 3 provisioning coverage ratio at 51%. On the recovery front, with continuous and focused efforts, we have witnessed a significant and consistent reduction in delinquency levels during the last year. We have also made technical write-off of 1080.57 crores during Q4 of FY24. And overall, the total technical write-off during the financial year 23-24 stood at 2,005.62 crores. On the funding side, we have witnessed an increase in the overall cost of funds by 13 basis points during last year from 7.63 to 7.76 and an increase of 6 basis points during the last quarter from 7.70 to 7.76. Incremental cost of funds stood at 7.84 for the full year and 7.90 for the quarter. Net interest margins for the year stood at 3.08 against 2.41 last year. During the last quarter, the interest rates were at elevated levels due to tight liquidity controls. However, we managed to keep our interest expense flat in comparison to Q3. We also renegotiated on some of our outstanding borrowings. The last year was a year of consolidation as well as one where several new initiatives were launched and implemented. Also, there was a significant focus on the recovery effort, which have led to improvement in asset quality. With this foundation, I believe we look forward to a strong financial year 25. With this brief introduction, I would like to invite you for your queries. Thank you.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Maruk from Nuvama. Please go ahead.
Yeah, hello sir, good morning.
Good morning, Maruk.
Yeah, hi. So my first question is on the write-off. So these were builder loans.
Ma'am, sorry to interrupt. Your voice is a little low. Can you use your handset?
Okay, I'll do that. Just give me a moment.
Yeah, sure.
Hello, can
Yeah.
you hear me now?
Yeah, better now.
Yes. My first question is on the write-off. Was it on builder loans?
No, Maruk ma'am, the write-off is on all loans, builder as well as IHL, which are provided for 100%. That means wherever there is a provision of 100%, these loans are eligible for write-off. So it would be a mix of both, not specifically builder loans. It would be a mix of both builder as retail, IHL, individual home loans.
And the repossessed assets are part of stage 2?
No, actually repossessed assets are stage 3.
They are stage 3. So the stage 2 provision has also gone up. ECL has also gone up a lot. That's why I asked.
Yeah.
Any explanation? Any reason for the stage 2 ECL being higher QOQ?
No, for the stage 2 you are asking?
Yes, stage 2.
Yeah, stage 2 there is the management overlay. It is because of the management overlay it has been increased.
Okay. And any DTA reversal because the tax rate is also higher?
No, as far as the tax rate is concerned, it is basically because of some old, I would say DTL for earlier years, which we have taken effect this year. Total amount is 127 crores approximately.
Okay, so it's the earlier years DTL.
Yeah.
And it will normalize to 19-20% going ahead?
Yeah, 19 to 20%.
Okay. Thanks a lot. Thank you.
Thank you. The next question is from the line of Abhijit Tibrewal from Motilal Oswal. Please go ahead.
Yeah, sir, good morning. Again, congratulations. I think, this has been a good quarter for us, except for maybe some one-offs and maybe slightly higher write-offs. So, I had 2 questions here. NIM is something that we are all kind of trying to wrap our heads around. As a franchise, we were not a business model which did NIMs in excess of 3%. So if you could help us understand what is it that has changed in the last 1 year that is allowing us to deliver this kind of NIMs, given that if you look at the sectoral level across HFCs, there seems to be some transient pain which is there. The margins, yields have largely maxed out. Cost of borrowing continues to rise. So that is one thing if you can help us understand, as well as kind of supplement it with your NIM outlook for the next year. That is one. And the other thing is, sir, your stage 3 has kind of declined by almost 2,500 crores. You just explained in your opening remarks that about 1,100 crores of technical write-offs that you took during the quarter. So where the other, decline that we've seen in stage 3, stage 2, they were more organic resolutions during the quarter.
Your second question first. Yes, there had been write-off to the tune of about 1,000 crores in the quarter. But despite that, we have been able to also work on the recoveries, and which was a focus area for the last 2 to 3 quarters. And we had also, I would say, given that commitment in the previous calls that we will certainly bring down the NPLs and the stage 3 accounts. And there was a decent visibility because we were working on those accounts for a fairly long period of time. So that has now come through, and that has given the movement that you have just referred. As far as your first question is concerned regarding margins, this is the 5th quarter in a row back to back that we have delivered margins at 3 or around 3. So this is not a one-off. It has been happening for the last 5 quarters, and you would have seen the trajectory ever since we have been able to take the benefit of the higher interest rate regime and passed on the rate hikes. And to that extent, because of the fact that our liabilities, half of it is fixed and half of it is floating, we have certainly benefited from that kind of a model. In fact, going further, if you look at and compare the interest expense for the Q4 and compare it against Q3, you will find that there is hardly any increase. So we have really worked hard and renegotiated, as we mentioned in the opening remarks. We have renegotiated on some of the borrowings that we had, and we were able to pull down the interest expense, which has resulted in creating the gap between the interest income and the expense. So that has actually resulted. On top of that, had a couple of resolutions of some high-ticket cases where we were able to collect the interest due on the NPA accounts as well. So that has also helped.
Got it, sir. Got it. So just one follow-up question on that. Just we are trying to understand this better. So what you just explained, resolution of high-ticket cases, and we were able to collect interest on that, and the same thing that you explained on the liability side, we seem to have benefited and maybe done better than many of our peers. So what you suggested, this NIM improvement that we are seeing in FY24 is more structural in nature, is the conclusion that I just wanted to draw. And so the other question that I had was on the asset quality bit. If I just look at our credit costs for the last maybe 3 years, 4 years post-COVID, they've been a little bit on the higher side. Must compliment you versus maybe FY22-23 levels. They have declined in FY24. So now, are we going to see that same trajectory, what you guided earlier, maybe 60 basis points in 24, moving towards more 40-45 basis points for the next couple of years? And sir, if you can also give that segmental NPA breakup that you give in our earnings.
Yeah, I will give you the segmental. I'll first answer that question regarding the credit cost. Yes, credit cost, certainly now we have reached a stage where the provisioning cover PCR on stage 3 is, I would say, probably one of the best in the peer segment. And we will like to hold it at around these levels. This is something that we had indicated, I think, 2 quarters back. So that 50% PCR we have achieved. As far as the other data points are concerned, you can just note it down. I will quickly read it. You can note it down. Individual home loans, IHL, the stage 3 is 1.48%. It has come down from 1.71. Then non-housing corporate, it is now 30.65. It has come down from 40.75. In the non-housing individual, it is now 5.46. It has come down from 6.50. This is, I'm talking of the December quarter and the current March quarter. And overall, if you add all the pieces together, it is currently the stage 3 is 3.31, and December it was 4.26.
This is useful. And sir, the other question that I asked was on the margin. Is this looks like sustainable margins now going ahead?
Yeah, as far as the margin is concerned, You asked about the margin, right?
Yes, sir.
Yeah, margin, I think we are now in the territory that 2.7 to 2.9 band can be delivered. I would say that is certainly the outlook. Comfortably, that should come through.
Got it, sir. And I'll come back in the question too, but congratulations and thank you.
Thank you.
Thank you. The next question is from the line of Varun from Kotak Securities. Please go ahead.
Hi, I'm audible.
Yeah, audible, Varun, audible.
I just want to ask a question regarding the expenses. If you look at the expenses, they're up 38% year-on-year and 42% quarter-on-quarter. Is this driven by some wage hike or a pension revision or something of the sort, or is it just on growth of employees?
No, Varun, if I talk of Q4, the increase in expenses which probably led to a lower PAT as compared to PBT. There were some one-off expenses which we had to take care of in Q4. Just to explain further, we had to make provisions for areas of wage revision. The wage revision of the employees is due now. So we had to make a provision for areas of wage revision to the tune of 32 crores. The method of calculation of gratuity also went a change, and because of that, our liabilities increased by 22 crores. A provision for that had to be made in Q4. And then tax expense, DTL, deferred tax liability of past years, we had to increase it by 227 crores. So slightly the tax portion is slightly skewed. It's much on the higher side. And the other part of it, ECL, yes, we also had to make an additional ECL provisioning of 100 crores to increase our PCR to 50, slightly higher than 50% as envisaged by or as directed by our board. So these were the one-offs that took place in Q4, as a result of which your operating expenses are slightly seen at a high level.
My second question is regarding the disbursement growth. So right now we have done about 15% in 4Q. But is this the sustainable rate that we should expect for next year, or will this go down?
No, I don't think there's any reason. I don't see any reason why it should go down. Yes, in the beginning of the year, we were constrained by these technological changes and the expansion in the organizational structure. But now things have stabilized, and whenever we opened 44 new cluster offices and 50 new area offices. Those delivered in the fourth quarter, and I think the fourth quarter was where we should have been right from the beginning of the year. So this 15% growth which we have shown in the fourth quarter is what we were expecting all through. And yes, I'm looking for a double-digit growth in this year. There is no reason why I don't see any sort of hindrances in the market, in the demand, which would hold us back.
Thanks. Those are the questions.
Thank you. The next question is from the line of Avinash Singh from MK Global. Please go ahead.
Yes, sir. Thanks for the opportunity. A couple of questions. The first one, if you can sort of provide some guidance on growth part. I'm not sure if I missed this. Particularly when you are going relatively slower on the project finance side, that's good. But if you can provide the growth guidance for next year. And the second question is that on one hand, you said that the margin improvement is a bit structural and you have done underlying work to improve it. But again, you are guiding for 2.7 to 2.9%, whereas the current year margin is 3.1%. So that's question two. And if I look at note 10, it says about repurchased asset held for sale reclassified. So that was 122 crore gross. You have provided already 18 crores. What is the additional provision now you have done on this if it has gone to stage 3? So these are my three questions. Thanks.
Sorry to interrupt. Ladies and gentlemen, we have lost the management line. Please stay connected while we reconnect them. Thank you. Ladies and gentlemen, thank you for patiently holding. We have the management line back with us. Thank you.
Yeah, Avinash, you can come in again.
Yeah. So I had three questions. The first one was if you can just guide for FY25 growth, particularly because, I mean, you are now going reasonably slow on the project finance side. So in that backdrop, what kind of disbursement or AUM growth you will see for FY25? That's number one. Number two was that, okay, you said on margin improvement that there are structural factors and you have done certain work that is helping you deliver better margin. But you are guiding for 2.7 to 2.9% vis-a-vis a current year margin of 3.1%. That's the second question. And third question, on note 10 to your accounts, that 122 crore gross loan that was classified as asset held for sale to now again loan at amortized cost. Because as you said that it would have gone in stage 3, what is the additional provision you have taken on this particular list? Thanks.
Yeah, Avinash, coming to the disbursement front, yes, the project loan have shown a degrowth. It is not that we have gone slow or anything of that sort. Yes, the project loans, we have been very, I would use the word, we have been a little bit guarded and conscious about project loans going by the legacy we have, a large build-up of NPAs in projects related to the loans we gave about 5 years back. Yes, we are slightly guarded on that, but we are not going slow on project loans. Yes, beginning of the year, as I said, we had some issues which we had to contend with, but Q4 we are back on track. So as far as disbursement is concerned, definitely a double-digit growth in disbursement and in the loan book is very much in the horizon for FY25. Coming to NIMS, I'll ask my CFO to take over NIMS.
Yeah, Avinash, actually, when we indicated 2.7 to 2.9, that's a wide band, I understand that, but the delivery will be closer to the higher end of the band for sure, and it will be done comfortably. We have closed the year with around, say, 3.08 for the full year. There is a possibility that there could be a rate cut or something like that, but overall, we are very confident that by and large, the steadiness will be there with a slight variation at most. Then your other question regarding the movement, that was basically because of the index change. Now we have, earlier it used to be in the held for sale category. Now it will be treated as a part of our overall loan portfolio. So there will be no change in the provisioning because earlier also the assets were provided for. It will be just a reclassification. Whatever provision was being held for that particular asset category will now get transferred to the general pool. That's all.
But I mean, you said it is under stage 3, so and you are indicating nearly 15% cover. So that's where I got confused. Yeah.
So that was because the index requires the provision to be made depending upon the underlying value of the security. So that there will be maybe 10-15 crores difference will be there. That's all.
Okay. Thank you.
Thank you. The next question is from the line of Gaurav Kochar from Mirae Asset. Please go ahead.
Yeah, hi, good morning.
Good morning, Gaurav.
Yeah, a few questions. Firstly, on the provisioning, if I look at stage 1, stage 2, stage 3, this quarter I observed that we have increased the cover on each of the 3 buckets. Going forward, as you alluded to earlier, that you are satisfied with stage 3 cover of 50% plus, and we are already there. And incrementally, assuming the PG, LGD assumptions do not change materially for the other buckets, and you're guiding for 40 basis point credit cost, where will that come from? Is my question, because if I read correctly, I mean, barring write-offs, the organic stage 3 reductions both in FY23 and FY24 were quite healthy. You had almost negligible net slippages in each of the 2 years. So going forward, if the net slippage number is going to be broadly similar, where will the 40 basis point provision come from?
So, Gaurav, actually the 40 basis points, if you see this year's provisioning trajectory also, so what we do is that whenever an asset moves on to a particular stage in terms of hardening of the bucket, say for example within the stage 3 itself, if there is further hardening, we increase the provisioning there for those particular accounts. This year also we have done the same. For example, wherever a stage 3 account has remained in stage 3, but it has moved from say 2 years to 3 years. So there we have increased the provisioning through a management overlay.
Okay. Okay, understood. So
And finally, the objective is that once it touches 100% provisioning, it will be written off.
all right.
Technical these write-offs, again, let me again mention that these are technical write-offs only. All follow-up and recovery action continues as it is.
Got it. Just two questions from this, two follow-up questions. One, of your total 6,200 odd crore ECL, how much is management overlay? And secondly, how big is this technical written-off pool now as we speak?
Technical write-off pool will be closer to 4,000 crores now, and management overlay of the 6,270 crores will be roughly around 17 to 1,800 crores.
All right. Understood. And sir, with respect to the, I think in the previous call you alluded to some transaction in pipeline for your wholesale book in terms of ARC sale or otherwise distressed accounts. So is that something in pipeline for FY25, and how much broadly rough, maybe a ballpark number that we can expect can come in this year?
Yes, Gaurav, yes, we have taken up ARCs last year. In fact, as a test case, we have put up a large account to the ARCs. I think they'll be coming back. Some 6-7 ARCs have shown interest. They would be coming back to us. We would be likely taking a call in probably, if not this month, in the next month. So let's see how it goes, how these ARCs goes. And then we'll take it forward. Difficult to give a guidance right now because it's not a very clear established practice in the company. We're just testing the waters right now. But definitely, if our experience is good, going by this big account we put up on the block, yes, we would be exploring the ARC option also for all the sticky and the hard loans which we feel are difficult to sort of resolve or settle.
Right. Got it. And so just last question on, again, the loan growth or disbursement growth target. If I look at full year this year, because we had an impact in the first half, the disbursement overall were 58,000 crore this year. Next year, if you're targeting a double-digit growth, I'm assuming a 12% number here. If we have to achieve that, the overall disbursement needs to be closer to 70,000 odd crore for next year. So are we confident of delivering, let's say, FY25, 70,000 crore kind of disbursement?
Yes, Gaurav, no reason. Right now, if you ask me, there is nothing, as I said, which should hold us back from achieving those numbers you've just quoted. Yes, we are targeting that.
Great, sir. Congrats on the quarter and very good luck for the coming year.
Thank you, Gaurav.
Thank you. The next question is from the line of Mohit Jain from Tara Capital. Please go ahead.
Hello. Yeah, good afternoon, sir. And congrats for a good number, sir. So I just wanted to understand on the NIM part, if I'm just comparing from December to March, incrementally I'm seeing the cumulative, the interest yield has gone down and the cost of funds have increased, both in the form of add-on date cost of fund as well as incremental cost of fund. So then, is the increase in NIM purely because of the recovery from the NPA cases, or is there something else to it?
No, if you look at it again, I would like to repeat what I just said in the previous question. Interest costs have not increased, but interest income has increased.
Mm-hmm. So, but if I'm just looking at the interest, the yield or the incremental.
I will come to that. I'm coming to that. But if you look at it that way, the interest expenses remain absolutely flat, no increase. Mm-hmm. Interest income, on the other hand, has shown some increase because of the increase in asset book, whatever little it is, but it has come through. So that has actually expanded the net interest income. Mm-hmm. As far as the yields and cost is concerned, that is actually the number which exists on the last day of the quarter. It does not reflect the entire quarter. How you will calculate? If you just take the interest expense and the interest income, which are the audited numbers available on the along with our financials, and you also have the opening and closing book, that will give you a very good understanding of the trajectory, which has actually shown an increase.
Okay, sir. Okay. And so just to reconfirm, you are saying for the next year loan growth also, we are expecting the AUM to grow in double digits.
Yeah, Mohit.
Okay. Thank you, sir.
Thank you. The next question is from the line of Shubhranashu Mishra from Phillip Capital. Please go ahead.
Good morning. Two questions. The first one is on the various appointments that we have done. So a lot of senior guys have come in from LIC who are in their late 50s and would be probably decent to housing finance business. So my question is that why are we not appointing professional managers in regional zones or zonal managers to run the housing finance business instead of taking it from the parents who are in their late 50s who may or may not have commensurate experience in running a housing finance business? And why are we giving close to a 500 crore dividend when we have so much of bad assets? So if we can conserve on that, we can probably add to our management overlay. That's the first. Second is, at a point in time, our gross stage 3 on the corporate book was 45%, implying that 50% of the book was bad. So why don't we just run it down and we say that okay, we'll only be a home loan company or an individual catering to individuals, and we won't do corporate assets at all. Thanks.
Yeah, Subhanshu, coming to your first question on the 6 or 7 new people who have come in from the promoters as senior management. Well, this has been a tradition in this company, I don't know since when, but since long, I'm sure. When the promoters do nominate their people as senior management personnel. So this is something which the promoters have to decide on getting professional people on board, as you are suggesting. So that was question number 1. And your question number 2 was, I think, question number 3, if I remember. I'll ask you on question 2 later on. Question 3 was on our corporate loan book, the project finance book, as you said, where 50% of the book is in stage 3. Well, let me tell you why are we are, and your question was why don't we completely drop the book and focus completely on individual housing loans. Well, let me tell you, if you look at the corporate loan book right now, approximately 5,000 to 6,000 crores of portfolio still remains there. And if you look at this bad debts or stage 3 exposure at default of the corporate loan book, this all pertains to loans given during a particular period, if I may be specific, between 2016 and 2019. So it is not that the corporate loan book or loans given during the last 3, 4, 5 years have been bad. Yes, there was a particular period in our sort of history when we did give loans which were not properly, which probably went bad. So I would not say that we'd give up on this project loan book, because we do see demand coming from this sector, and there are a lot of good builders. Slightly riskier, I do agree, but of course margins also are available. So we are not looking at dropping this entire loan book altogether. Yes, we would be cautious, we would be slow, but definitely we'd like to do business in this segment also. And what was the second question, Gaurav? I just missed it.
So why are we giving dividend of roughly 500 crores to the parent? We can add it to the management overlay and not give dividend at all, right?
See, Subhanshu, what you said technically, I mean, it is a correct observation, but the fact is that we have been a dividend-paying company since the inception, and we would like to continue with it, because we have got a decent number of retail shareholders as well, for whom probably this payout is a bit important as compared to many of the institutional investors for whom it may not matter much. But for the retail investors, and we have got a sizable number of retail investors, for them it is important. We have increased the dividend payout only marginally from 425 to, that is 8.5 rupees a share, to 9 rupees, and that is also after 3 years. 3 years we did not increase. This is the 4th year, and this time the profits have also been quite good. And I would like to also add that as compared to last year, the payout ratio has actually come down significantly. Till last year, for the last almost 10-15 years, the dividend payout ratio used to hover around between 16 to 20%. For FY24 dividend that we have declared yesterday, the payout ratio is just a little above 10%. It is a little 10.5%.
Understood, sir. Look forward to tremendous growth in FY25. Thank you.
Thank you. Thank you, Subhanshu.
Thank you. The next question is from the line of Rajiv Pathak from GC Holdings. Please go ahead.
Yeah. Good afternoon, sir.
Yeah.
My first question is on the spreads and the margins. So I think Sudipto alluded to the fact that the spreads are at the period end, and probably the margins and everything are on an average basis. So if you can have an comparable spread, so the yield and the cost number on an average basis, that would be helpful.
See, actually, if you look at on an average basis, I think the cost number is working out around somewhere around 7.3 or 7.4.
Okay. Okay. So then even the spread would have shown a similar kind of an increase, right?
The spread also would have, you're absolutely right, the spread also would have shown a similar trajectory between the period under comparison, which I tried to explain to in the previous query.
Okay. Okay. And so on this margin especially, so you would have a good amount of recoveries that have happened in this quarter. And I think you touched upon that you also have the interest recovery that you have done on those accounts. What would be the amount that would be sitting in that NII line?
It will be a little less than 100 crores.
Less than 100 crores.
Yeah.
Okay. And so that is...
And that actually, if you look at the comparison between Q3 and Q4, it is more or less fixed.
Okay. And Sudipto, if you can share the incremental yield and the incremental cost?
Yeah, just a minute. The incremental yield on our, combined asset book, just a minute, I'll just share it. The incremental yield is around 9.9.
Okay.
And it is this is the weighted average. That is 9.9, and the cost is around 7.76. This is on
This is the outstanding, right?
Yeah, outstanding.
And on incremental basis?
On incremental basis, the borrowing cost is 7.84 for the full year.
Okay.
And the incremental yield for the full year put together is something around more than 9.4 or thereabouts.
Okay. And just one point on the recovery. So I think you guys are doing a good recovery this quarter. How much would be that amount, and what would be your target for the next year?
Well, difficult, Mr. Pathak, very difficult to quote a number or as such. But definitely, there has been a lot of focus on recovery, and we have done a lot of hard work in the previous financial year, FY23-24, which is reflected by the stage 3 EAD percent of 3.31, down from 4.37 at the end of 31st March of 23. Yes, I'm pretty sure the hard work we put in last year will bear fruits and results in this current financial year, and definitely you can see the percentage stage 3 EAD going down even further. But difficult to quote a number as such.
Okay.
I think trajectory-wise, it is now very clear. Yeah. Very clear the way we have put in a lot of efforts in FY24, especially in the second part of the year, and we have given this, you can say, guidance or indication also that we have got very good visibility, and that visibility it continues. And as we mentioned, some good big ticket cases we are moving in terms of ARC. On-ground follow-up continues, and that now we have reached a stage where probably from here it will go down only.
So it will be fair to assume a downward sloping NPA numbers versus the spike that we saw in intermediate quarter last year.
So now it is, I think, trajectory-wise, it is very clear. It is a downward trending.
Okay. Thank you so much, and wish you all the best.
Thank you.
Thank you. The next question is from the line of Abhijit Tibrewal from Motilal Oswal. Please go ahead.
Yeah, thank you for this follow-up. So again, kind of coming back to the name, just wanted to understand in addition to those recoveries that we have had from some of the accounts where we have seen resolution, is there also some kind of a product or, the customer mix change that you are seeing in your IHL book?
Actually, if you look at on a year-on-year basis, the incremental yield for the IHL incrementally has increased because we got the benefit of a higher interest rate regime in FY24 as compared to the whole of FY23. So that has helped.
Got it. And then, sir, just to clarify, I mean, all those one-offs that you spoke about, especially on the OPEX side, employee expenses, they are in the nature of one-offs, right? Which essentially means that from next quarter onwards, we will again go back to those 140-150 crore of quarterly run rate in terms of employee expenses.
There were 3 one-offs in the expense line. If you look at it, there are 2 which had impacted the employee cost and 1 which is a non-employee cost. So as far as the employee costs are concerned, there is a wage revision arrears which is a one-off. We have always been providing, but this is slightly more to bridge the gap. So that has already been done, 32 crores for that. Arrears for gratuity, some little change in the calculation, that is a one-off. That is done. These are the 2 on the employee side. So now if you compare it with the expense on the employee benefits vis-a-vis Q3, you will get a clear picture of where the trend line has moved. Now coming to the non-employee expense, predominantly it was a publicity of around 15-16 crores, and if you recollect last year, FY24, during the first 6 months, there were a lot of operational issues, and we had gone a little slow on the publicity and the visibility exercise, which has picked up in the third and especially in the fourth quarter. It has also given us good results on the marketing side. So that has been a 15 crore that is in the Q4 itself. Now, if you look at the non-employee expense on a full year basis, FY23 compared with FY24, you will find that the growth is about 9%.
Right, it's up 9%. Got it, sir. I think this is useful. That's all from me. Thank you so much.
Thank you.
Thank you. The next question is from the line of Akash Goel from Tara Capital Partners. Please go ahead.
Hello.
Yeah, hi Akash.
Yeah, hi sir. I just wanted to confirm the disbursement expectation that you were sharing. So were you sharing a double-digit kind of a growth on the FY24 base, or I think you alluded to a 70,000 crore disbursement also being possible. So that would be a double-digit growth on FY23 base. So just that confusion I had.
No, on FY24, our disbursements were 53,500 crores, right, approximately. And if you compare it to, total it was 58,937 crores, to be precise.
Yeah.
Right? So definitely a double digit from this, and even if you compare it to FY23, 64,115, I would say a double digit from there also is not, I would say, unconceivable. We have put all the worries behind us. Q4 of FY24 growth around about 15%. Yes, definitely this gives us the confidence that FY25 double digit, there will be a double digit growth. So whether you compare it to FY23 or 24.
Got it. Okay, sir. Thank you so much.
Thank you.
Thank you. The next question is from the line of Deepak Poddar from Sapphire Capital. Please go ahead.
Yeah, am I audible, sir?
Yeah, Deepak, you're audible.
Yeah, thank you very much, sir, for this opportunity. So just first up, the areas from gratuity adjustment, what was the quantum you mentioned?
22 crores.
So 32 crores is wage revision and 22 crores is gratuity.
Gratuity, yeah.
But your other expense, if you see, the increase has been much sharper, right? I mean, from a range of 70 crores to 115 crores. And publicity expense is about 15 crores. So increase is about close to 45 crores, right? So there is some 30 crores increase also in other expense, which you are saying is not one-off.
No, see, actually, Deepak, right?
Yes, that's correct.
Deepak, actually you have to see it in the full year basis. As I mentioned, publicity is one of a lumpy one. There are other promotional expenses which we did not incur in the first half of the year, which got pushed to the second and third quarters, especially in the fourth quarter. So that is the reason why I said that you have to look at it on a full year basis.
Okay. I got it. So what is the cost to income we are looking at in FY25?
Cost to income ratio has come down, and that's a very good question you have raised. Cost to income ratio last year was 15, FY24 is around 13.
Correct. It was around 13.3%.
Correct.
So how do we see that for FY25?
I think it will remain by and large steady. It will remain by and large steady. Obviously, we will be working towards reducing it, but it will be remaining by and large steady.
At 13 to 13.5%.
Yes, ballpark, that could be the range.
Okay, fair. And given, YOY, you have mentioned a lower band for NIMS, right? As against 3.2% that we have done this year, we are looking for in a band of maybe 2.7 to 2.9. So on that backdrop with a steady cost income, do we expect our ROA to drop in FY25?
See, first of all is that we have not delivered 3.2 this year. We have delivered 3.08. On a full year basis.
Yeah, for this quarter it was about 3.1 round.
Yeah, let us quarter you should look at it on a full year basis because we are discussing on a full year number basis. Yes, in fact, what I mentioned earlier also in one of the previous queries is that the delivery will be towards the higher end of the band, and that will be done very comfortably. Obviously, there is a possibility that there could be a rate cut during the current financial year because of RBI action, etc. So we're just trying to keep that as some kind of a buffer. But for all practical purposes, it will remain steady.
Even the ROA also we are...
ROA is just a derivation of the profit numbers.
Correct. Fair enough. I think, that would be it from my side. I think, all the very best to you. Thank you so much.
Thank you, Deepak.
Thank you. The next question is from the line of Sankat from DAM Capital. Please go ahead. Mr. Sankat, your line has been unmuted. Please go ahead with your question.
Yeah, hi. Am I audible?
Yeah, Sanket, audible.
Yeah. So just to reconfirm, you said the technically written off pool that we have is around 4,000 crores and overlay is around 17 to 1,800 crores. Is that correct?
Yeah.
Okay. Sure, sir. All other questions were answered. Yeah.
Thank you, Sanket.
Thank you. The next question is from the line of Maruk from Nuama. Please go ahead.
Yeah, hello, sir.
Yeah. Hello, Maruk.
Yeah. Yes, hi. So, I just wanted to know that suppose whenever the rates are cut, what will be your reset? So say if repo rate is cut today, when will you pass on lower rates to borrowers? After what gap?
Generally, next quarter.
Okay.
Beginning of next quarter.
Okay. Got it. So if the rates are cut today, you will pass it on in the second quarter. That is.
Yeah.
Okay. Thank you.
Thank you. The next question is from the line of Vipul Kumar Anopchand Shah from Shubmangal Investment. Please go ahead.
Hi, sir. Thanks for the opportunity. So, what are the technical write-offs? Can you explain it? I just am not able to follow it.
See, technical write-offs are write-offs which is basically an accounting treatment. So it is removed from the books of accounts, but the loan continues to be there in the ledger, and all follow-up, recovery, legal, everything continues. You can say just it's a cleanup.
Okay, but then what will happen to the provision for that?
Ladies and gentlemen, we have lost the management line. Please wait while we reconnect them. Thank you.
Yeah, Praveen.
Hello.
Hello.
Yes, yes, sir. So my question was, can it happen only after they are provided 100%?
Yes. Only cases where 100% provisions have been made can be technically written off.
Okay, thank you, sir. And one small suggestion, if you can make it as a part of presentation, all segmental NPAs and provisions for those particular subjects.
Point taken. We'll do that. Next quarter, we'll do that.
Thank you, sir, and all the best.
Thank you.
Thank you. The next question is from the line of Puneet Bhalani from Macquarie Capital. Please go ahead.
Hello, sir. Am I audible?
Yeah. Amit, you're audible.
Yeah. Just to confirm one thing, the 1,000 crores is the write-off for this quarter, right?
Yeah.
Yeah. Okay. And what will be the recoveries?
The recoveries from these write-offs?
No, recovery as in the entire pool from GNPA recovery.
Recovery, actually, almost 500 crores we have recovered.
Okay. Got it. Okay. Thank you.
Thank you. The next question is from the line of Rajiv Mehta from Yes Securities. Please go ahead.
Yeah, hi. Good afternoon and congratulations on strong performance. So I have a few questions. So these two, first on this incremental cost of fund being 7.9 and the stock cost of fund being 7.76. Would this understanding be correct that the stock cost of fund need not go to incremental cost of fund because you may even in the future renegotiate on the current borrowings?
Yeah. Actually, if you look at it, the incremental cost is only because of the Q4, especially the March phenomena where there was a tremendous liquidity pressure and negative liquidity situations. Now, the same number in April will be much, much less.
Okay. Got that. And on this senior management, personnel appointments, I think I see you've appointed 5 GMs and 4 regional managers. So is it augmentation of the senior management team, operational management, or is it the replacement of people who have gone? Can you give more color on that?
No, this is just a replacement, Rajiv. This is just a replacement.
Okay. Understood. And just 2 more things. What is the assessment of recovery from the written off pool, which is 4,000 odd crore? So you can sell to ARC for cash and then you can also recover yourself. But can you just give some ballpark number that out of this 4,000 odd crore, what is the current recoverability assessment?
Well, Rajiv, difficult to give you a number as such because recoveries is always, these are all sticky loans. Most of the 4,000 odd crores, especially in the builder book, these are all in litigation, IBC, NCLT and all that. And litigation, as you know, is always a slow process. Litigation always leads to further litigation. So difficult to give a number to that. But definitely, I can give you the trend is very clear that the asset pool is improving. And our EAD exposure at default, especially stage 3, is coming down. This will continue. This will definitely continue.
Got it. And just lastly, how do you define management overlay as 1,800 crore? Is it just what is over and above the ECL model?
Yeah,
that is over and above the ECL model. Here we apply our own judgment to loans which are in various stages, stage 1, stage 2, stage 3, where we feel that there is some stress build up or there is some additional risk. So we do make a judgment and make an additional provision. So that is called management overlay.
That is basically you can say a buffer over a buffer actually.
And so what is the view? I mean, how much more buffer we would build? Because I'm trying to link it to credit cost.
Stage 3 we are clear. Stage 3, I think we have already reached a stage which is very good in terms of comparison with our peers. Probably one of the highest, if not the highest in our peer group. So I think that way it is absolutely fine. Stage 1, stage 2, there are no challenges. Because stage 1 is standard assets. And we have done a decent amount of provision. Stage 2 also we have done a decent amount of provision there. Don't see much space I think there is no space further in buffering up. Only what actually happens is that the management overlay comes in when in stage 3 itself it moves from say a 2-year NPA to a 3-year NPA, or from a 3-year NPA it moves on to a 5-year NPA bucket.
Got that. Thank you so much and best of luck.
Thank you, Rajiv.
Thank you. Ladies and gentlemen, that was the last question for today's conference call. I would like to hand the conference over to the management for closing comments.
Well, thank you, friends. In conclusion, I would like to thank you all for your continued support, and I look forward to your support in future as well. As in FY24, I believe we did a reasonable job, and the results for the entire year as a whole was good. Yes, many areas of improvement, and we as a management, as a company, we are focused in all these areas. Looking forward to a fantastic FY25, and looking forward for your support in future as well. Thank you.
On behalf of Axis Capital Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.